Off the lows, but still down pretty much across the board. We got as low as down more than 300 on the Dow. Joining us is Mira Pandit, global market strategist at JPMorgan Asset Management. Mira, as we gear up for earnings season, the focus has all been on these macro numbers, inflation, which we'll get tomorrow, what the Fed is going to do. But the bearers, at least for equities, their argument is we haven't really factored in weaker earnings or weaker fundamentals for corporate America. What do you expect to see?
We do anticipate, and I think there's broad consensus that we should be seeing some downward earnings revisions and some more realistic expectations on profits, which are looking really rosy right now. But at the same time, I still think we could eke out some positive earnings growth for the year as a whole, because we do have a pretty good cushion here in terms of margins. Now, what we're still looking for, though, when we hear guidance from different companies is how is pricing power being exercised at this point? How resilient is consumer demand? What is the situation with inventories, whether it's a glut or still some challenges in replenishing? And ultimately, how are companies managing through this pricing environment? Is there going to be any indication of employment changes, whether it's hiring freezes or layoffs? Those are the kind of indications that are going to help us understand how do revenues fare for the rest of the year, and how do companies defend their margins?
So with that said, what are you telling clients to do? Which sectors, what types of companies?
Ultimately, we're looking for different sectors and companies that can exercise this pricing power and do tend to have a little bit more operating leverage. We tend to see that in more of the value-oriented companies, whether it's energy, materials, or financials that are able to more efficiently earn profits. But at the same time, it's not a wholesale one sector or one industry or the other. It's really going to be on a company-by-company basis, because we see a lot of differentiation under the surface between how different companies are withstanding this environment.
What about growth versus value? That sort of debate is heating up again now as we wonder whether inflation has peaked. Another really strong down day for oil.
Even if inflation has peaked, we're still likely to see high inflation throughout the rest of the year. I mean, even if inflation gets to, maybe 5% by the end of the year, that's still an environment of high inflation. Even as we think about next year potentially being closer to 3% on inflation, a lot higher than we've experienced historically, at least in the last 10 or 15 years. So there's still definitely a case to own value in this type of environment. But as we head to the back half of the year and growth does become a little bit more scarce in the economy, people are going to be looking for it in portfolios. And even if the Fed doesn't necessarily pause or pivot this year, we're likely to see a slowing pace in terms of those incremental rate hikes. And if most of the Fed hiking cycle is done by the end of the year, then that does remove a serious headwind to a lot of growth, which would have experienced a massive repricing throughout the year already by that point.
Mira Pandit, thanks for your view. Stick with value over growth.